Happy Monday out there, Team 42. It's your skipper here, Darius to present our macro minute for Monday, September 9th, 2024. Hope everyone had a wonderful football Sunday. So, as always, we'll start with our executive summary from today's leadoff warning note. If you would like to review the analysis supporting these conclusions, as well as what specific changes you need to make in your portfolio to remain on the right side of market risk, you need to be a client of 42 Macro. So, today's key macro questions are: will seasonal cross-asset volatility continue? Will Beijing step up fiscal monetary support of the Chinese economy? And what's going on with the crypto market? Our answers are: this week features a bevy of key macro and policy updates that may contribute to the nervousness observed recently across asset markets, most notably the Kamala Harris-Donald Trump presidential debate on Tuesday, US CPI on Wednesday, and the ECB rate decision on Thursday. China's August inflation data were supportive of our China eases, Japan displeases theme. Bitcoin and Ethereum are up 1% to 2% today, finding some reprieve after last week's corrections that deepened the drawdowns from their respective 52-week highs to 25% and 43%, respectively. It should be worth noting that these markets peaked back in March, which frankly is incongruent with the tall tales that we have heard all year about global liquidity on the free podcast circuit. The 42 Macro Global Liquidity Monitor is currently calling for a slight decrease in liquidity over the medium term. Transitioning to our 42 Macro dashboard, this one we'll wrap up as always with a question from our community. This one's regarding higher cyclical inflation. It says, hey, DD, came across a couple of reports recently from the UK stating they needed $1 trillion of investment over the next decade for various sectors in terms of housing, energy, infrastructure to achieve 3% growth. That sounds like a lot of capital for not very much growth, given the size of the UK economy is currently about $3 trillion. Number two, Mario Draghi calling for an additional 800 billion euros of capital investment with respect to a new industrial strategy for Europe. And so the question reads, does this feed into your higher cyclical inflation projections? Where's all this money coming from when governments already have such high levels of debt and deficits? So I'll start by saying, so these numbers these numbers are not feeding into our higher cyclical inflation projections, at least for these economies, because the two economies we were talking about here, the UK economy and the Eurozone economy, our grid model is calling for inflation to continue decelerating in those economies, into, I'm going to say, through Q4 of this year and starting to reaccelerate in the first half of next year. So these numbers are, these projections aren't going to impact that. Obviously, this is not real policy that's been implemented. However, we continue to pound the table in the context of our investing during the fourth turning regime analysis that we are in a higher inflationary era that's being in part driven by populism, from a fiscal standpoint. And so you should expect as an investor for us to continue to see populism as the modal outcome from the perspective of fiscal policy. And with respect to monetary policy, the role that monetary policymakers have to play in this era is to allow, is to artificially engineer demand for, sovereign debt securities, amid all this excessive growth and public debts and deficits. So when you think about this, specifically from the perspective of the U.S. market, just kind of thinking about this in U.S. terms, I want to say the private sector accounted for 36% of the marketable treasury market back in December of 2021. It has since accelerated over the past few years to about 52% of the private non-financial sector. The private marketable. The marketable treasury market. And so the private sector now owns more than half of marketable treasury securities. And in our opinion, the process from going from 36% to 52% was one of the reasons we saw such a significant backup in interest rates, particularly in the long end of the curve, going back to 2022 and 2023, because again, the cohorts that buy treasuries and sovereign debt generally around the world, like central banks, and foreign reserve managers and commercial banks, each of those cohorts have been reducing their share in recent years, and it's caused us, the private sector, to have to capitalize global sovereign debt markets more. So that's something that investors need to be aware of, that, once we start to get, move forward in time, 1 year from now, 2 years from now, 3 years from now, and we continue to layer on debt and deficits through the lens of populism, these things are going to come at a higher and higher cost relative to what we have been used to, going in the pre-COVID era, which was we could grow debt, and because the Fed and the commercial banks and former central banks were expanding their balance sheets to take advantage of that, it didn't really have much market impact. But now going forward, it's likely to have significant market impact when we have these, populist policies hitting the tape. So just be aware of that as an investor. This is something we're going to be dealing with for quite some time. Doesn't necessarily mean it has market impact today, but generally speaking, this is the framework you need to be thinking about, the approaching asset markets with over the medium term. And ultimately, we expect central banks to acquiesce and do what they need to do from a balance sheet perspective to make this process easier. It just might not be a linear process. And it's probably not going to be a linear process. It never is. And so that's why we get paid as investors to take risks. So we'll wrap it up there. Darius Dale presenting our macro minute for Monday, September 9th, 2024. Best of luck out there today. Everyone have a wonderful day. We'll catch you back here tomorrow. Cheers.